The following video is an extract from the Udemy course, Learn to Construct Financial Statements from the Ground Up. If you would like to purchase the full course, you can do so by using the link below. Hello and welcome back to our next tutorial. In this tutorial, we will be introducing you to the accounting basics. What we're going to cover in this tutorial is set out here. First, we're going to set out the definition of accounting. We are then going to introduce you and distinguish between an accruals basis of accounting and a cash basis of accounting, before then introducing you to the three primary statements. The three primary statements are set out here. There's the income statement, the balance sheet, and the cash flow statement. Now we'll be introducing those in more detail in the next tutorial, but for the purposes of this lesson, we just want to introduce you to these three statements. Firstly, a definition of accounting. Accounting is the process of recording financial transactions within a business. This includes summarizing, analyzing, and reporting the transactions to various stakeholders, including managers, an owner of a business, board of directors, regulators, investors, and tax authorities as appropriate to that business. The financial statements used in accounting are a concise summary of transactions over an accounting period, summarising a company's financial performance, position, and also cash flows during that period. So in terms of then the three primary statements, there is an income statement, a balance sheet, and a cash flow statement. They are the three primary statements comprising the financial statements. So the first one is the income statement. An indicative income statement may look something like this. An income statement records a company's revenues less their expenses to give a profit or loss over an accounting period. So the key takeaway for the income statement is that it reports over a period of time. So in this income statement here, the company is called XYZ Limited, and they are reporting over, in this instance, a 12-month period, the year ending 31 December 20x4. Just think of 20x4 as 2004, say, a year. So some key features of this income statement and any income statement is there will typically be revenues, less expenses to arrive at a profit or loss for the accounting period. The second key primary statement is the balance sheet. The balance sheet may look something like this. A balance sheet sets out an organization's assets, liabilities, and equity at a point in time. So we will introduce in the next tutorial what an asset is, what a liability, and what equity is. But for now, just become familiar with the structure of a balance sheet. And a key takeaway is that the balance sheet reports on those items I just mentioned at a point in time, whereas the income statement we covered was over a period of time. So for example, in this balance sheet, we've got assets. We'll come to the assets, but I suppose just to follow up that point in terms of the point of time, this balance sheet is setting out XYZ Limited's assets, liabilities, and equity as at 31 December 20x4. So that is a point in time. And then in terms of the structure of the balance sheet, we have got assets in this section of the balance sheet. Now we'll distinguish between a non-current asset and a current asset in the next tutorial, but for now just be aware of where the assets are located in this balance sheet. The second item is the liabilities. This balance sheet summarizes liabilities between creditors due within 1 year and creditors due in a period greater than 1 year. But for now, just be familiar that the liabilities in this balance sheet are located here. And the final item then is equity. Equity is located in this section of the balance sheet, and we will cover what equity is in the next tutorial. We'll get there, don't worry about that. In terms of then the third primary statement, the cash flow statement, we're not going to illustrate the cash flow statement for now. I just want to introduce you to the income statement and balance sheet, and then we will introduce what the cash flow statement is. But for now, all you need to know is that the cash flow statement reconciles the cash at the beginning of the period to the cash position at the end of that accounting period. Those movements then are summarized between or classified between operating activities, investing activities, and financing activities.